HSBC, Europe's largest bank, planning to cut 25,000 full-time jobs across the world as part of the lender's plan to save $5 billion annually by 2017. For more, we're joined by Bloomberg Intelligence banking analyst Jonathan Tyce. We're also joined by Blain, strategist at Mint Partners. Jonathan, let's get to you first. Looking at the open, we're down about 0.5%. Let's just call it flat and unchanged. Was there anything in that release that surprised you, or did it all just tick those boxes next to expectations?
I think the only thing that may have surprised a little is how little actual disposals are going on. So Turkey and Brazil gone. They've just put out the presentations we were looking through a few minutes ago.
Yeah.
And a lot of it's about things like risk-weighted asset mitigation. They're shrinking the balance sheet, but some of it is by changing accounting standards. So perhaps it's a good cost number, and I don't think people will have a problem believing they'll deliver on that. But in terms of kind of how radical the restructuring is, and how much clarity we've got on things like, say, for the GBM, they're looking at nearly doubling the return on risk-weighted assets by 2017. How do you actually do that in this environment? I think there'll probably be a bit of scepticism about kind of where the revenues go. I don't think people will worry too much about the costs, and I think the fact they've said progressive dividend, they're signalling positive outlook for capital, though they still haven't given us capital targets.
Bill, HSBC alumni, are you sceptical about the outlook for the revenue environment?
Not particularly. I'm not the least bit worried about HSBC on its own. I think it is going to be one of the winner banks. But I think this is the end of the era of investment banking. What we've seen is a 20-year phase where investment bankers have increasingly got to the top of all the major banks and been setting the agenda. And now we're seeing that come to an end. Earlier this week it was Deutsche Bank with Jane being politely shown the door. I think it's now got to a stage where regulation and the end of the global financial crisis means that banks have to reinvent themselves to be simply banks. And that requires proper bankers running the organisations, which is why you're seeing managers brought in rather than the kind of guys we saw in the past, the gifted investment bankers who had created investment banking empires running the show. We're now going to see proper managers running the show, and that's why I'm confident that a firm like HSBC, which has a really good bench of competent managers, sure, when I was there was quite a lot of but they have got the capability to put in place a new working model, so I'm pretty sure they'll work. The question is about other banks and how do they follow them. I also think it would be a mistake if, as some people have suggested, that HSBC flees the country and moves to Asia and sets itself up here, somewhere else. This is actually a pretty good place for banks to be. But let's see what happens. I don't think we're at the end of the banking story yet, though.
We'll get to your point on investment banking in just a moment. Jonathan, on the topic of the headquarters of HSBC, there's a debate at the moment. Is it a bigger loss for the City of London, or are the implications bigger for HSBC if they move?
I mean, the implications will be bigger for HSBC. There's significant cost. For them, this is about capital efficiency. It's about where TLAC, where there's systemically important buffer, how big would it be if the HKMA was the regulator, etc. To be honest, I think they're making all the right noises. They're saying we want to grow the UK. One of their 10 points is UK ring fence. So I don't think they're holding anybody to ransom. I don't think that's one of the bigger issues.
Yep.
Back to the point about investment banking. Yeah. I mean, actually, if you look at GBM, global banking markets, that's going to be less than 1/3 of risk-weighted assets. What you would call investment banking is about 10% of group, because they have balance sheet management. No other bank includes that. They have cash management. They're a proper corporate global bank, and a lot of what they do in GBM is to facilitate client trade. So it's a very different thing from a Deutsche, for example.
Yeah,
but that said, emerging market banks, Standard Chartered has the same issue. You need to grow revenues faster than costs. They've given us an absolute cost number, but we still need to understand where you've got wage inflation as high as it is across Asia, how do they manage the revenue base? And that's the thing that I think they're going to need to get across today, is how much of this kind of new targets, the ROE of 10%, they changed a full year anyway. So there aren't very many new targets, but there's a lot of detail in the presentations.
One thing we've barely talked about is the politics of all this. Reviewing the headquarters, cynics out there say, well, that's very political, that's nothing to do with the finances. This is a bank that's been surrounding in a regulatory and political storm. This week, Osborne is said to, reportedly, plan to end the era of banker bashing. Is that about to end?
Well, that would be a grand thing if it did end. I think bankers have been unfairly pilloried for the mistakes that were a result of society rather than banking. But I think it would be a mistake for any bank to think that this is a good moment to be moving into the emerging markets. So let's knock that one on the head straight away. If we can establish that the era of investment banking bashing is over, we also have to establish a new base. And I think you're absolutely quite right about what format these new banks take, which is to facilitate cash transfers and cash movements in corporate banking. And then we have seen the development, the evolution in the last couple of years of an increasing non-bank lending sector. Some of these institutions will be globally systemically important, SIFIs as they're called, but the way that finance is developing, I think we'll have a very different market in a few years' time. But again, I say, the era of investment banking is dead. The future belongs, which camera? The future belongs to brokers.
Well, you would say that. I think Bill's talking his book a little bit. In 2007, 2006, you wanted to be this big bulge bracket investment bank. That's what the modern bank looked like. That's what the RBS of this world aspired to be, and look where it got them. Here we are in 2015, and I get a lot of investors in various banks coming on the show and say, we want change. It's about Deutsche Bank, we want change. If I ask the question, is there a bank, not just in Europe, but across the world, that is the modern-day 2015 and beyond bank that everyone else is aspiring to be? What bank is that, Jonathan?
Well, there isn't one, but I can give you a bank that has changed successfully. UBS. UBS has completely reinvented itself, refocused. It was ahead of the curve in terms of capital intensity, did a lot of cost-cutting. It's changed direction dramatically, and maybe Credit Suisse goes down that route. And HSBC is a very different beast.
Yeah.
And an HSBC is more of a sort of JP Morgan, Citigroup, global presence. Is there a bank that other people aspire to be? Well, you want to be well capitalised, be able to return capital and have growth. UBS is doing that.
And be properly managed. Managed for growth rather than managed for market share.